All right, let's talk about something that sounds kind of complicated and, let's be honest, a little boring: tariffs. But here's the thing: they're basically a hidden tax on almost everything you buy, and they have this huge real world impact on your wallet and the entire global economy. So let's figure out how they work.
So let's start with a really practical question. How is it possible that a trade argument happening in China can make the washing machine you're about to buy in America more expensive? I mean, it seems disconnected, right? Well, the answer is a tariff. And once you get it, you'll see how connected our world really is.
Okay, so what is a tariff? The simplest way to think about it is it's just a tax. It's a tax on stuff that's brought into a country from somewhere else. You can picture a giant container ship pulling into a port. Before any of those products can come off the ship and get to the stores, the government puts a fee on them. That fee, that's the tariff. It's literally like a toll booth, but for products.
So how does this actually hit your bank account? Let's use some easy numbers. Say an imported washing machine costs $500. If the government slaps a 20% tariff on it, that adds another $100 to the price. And that cost doesn't just vanish, it gets passed straight to you. So the price you see in the store suddenly jumps to $600. You're the one paying that border tax. And that brings up a really obvious question, right? If tariffs just make things more expensive for your own people, why on earth would a government do it? Well, this gets into an idea called protectionism. Let's break down the thinking behind it. So, governments usually give three main reasons for this. The biggest one, the one you hear about all the time, is about protecting jobs and industries right here at home from cheaper stuff coming in from other countries. Another reason is pretty simple: money. A tariff is a tax, and taxes bring in revenue for the government. And finally, they can be used as a weapon, a bargaining chip in tough political negotiations with other countries.
The main economic goal is really straightforward. By making the imported stuff more expensive, the stuff made in your own country suddenly looks like a better deal. The hope is that you, the shopper, will choose the local option because it's now relatively cheaper, and that gives a boost to local companies.
But here's the thing about economics. There are always trade-offs. A decision that helps one group almost always costs another group somewhere else. So when a tariff gets put in place, who are the real winners? Who are the losers? And where do you fit into all of this? So you can picture what happens in the market pretty easily. As the imports get more expensive thanks to the tariff, domestic companies, who are now kind of shielded from that foreign competition, they can start making and selling more of their own stuff. And at the same time, the number of imported goods coming into the country goes down. The balance just shifts from foreign companies to domestic ones. Let's just lay it all out nice and clear. The winners? Domestic companies, for sure. They get to sell more products, often at a higher price. The government also wins because it's collecting all that new tax money. But there are definite losers. You, the consumer, lose because you're paying higher prices for pretty much everything. And this is a big one, a country's own exporters can lose big time when other countries decide to fight back with their own tariffs. And we're not talking about small change here. This is real money out of your pocket. One study on the 2018 tariffs found that they cost the average American household about $1,000. That is a direct hit to a family's budget. And this is where it gets really ironic. A government might use a tariff to try and save jobs in one industry, but in doing so, it can actually destroy jobs in others. A Federal Reserve study looked at the tariffs on steel and aluminum. Sure, they might have helped the metal-making industry a bit, but what about all the other factories that use steel and aluminum to build things, like cars or washing machines or buildings? For them, the price of their raw materials just went up, and that led to an estimated loss of around 75,000 jobs. But look, all of that is just what happens inside one country. That's only half the story. A tariff is almost never a single, isolated event. It usually sets off a chain reaction across the world, one that can quickly escalate into what we call a trade war. The US-China trade war is a perfect and recent example. It kicked off in March 2018 when the US put tariffs on steel. By July, those tariffs were hitting billions of dollars worth of Chinese products. Well, China didn't just sit there. In August, they hit back with tariffs on American goods. And by September, the U.S. doubled down, targeting another $200 billion in products. You can just see it escalate, tit for tat. And what you see here is this really predictable, damaging cycle. Country A puts on a tariff. Country B gets mad and retaliates. And all of a sudden, these incredibly complex global supply chains that took decades to build start to break down. And what's the end result? Businesses everywhere are scrambling. and consumers in both countries just end up paying more. It's a lose-lose situation. You know, this whole thing, it isn't new. In fact, history has a very powerful and frankly pretty terrifying lesson for us on what happens when this kind of thing spirals out of control. It's a major warning about the global ripple effect. Seriously, we have a historical playbook for this exact situation, and it serves as a really stark reminder of how bad things can get. We have to go back to 1930, right as the Great Depression was kicking off. The U.S. passed something called the Smoot-Hawley Tariff Act. It was this massive protectionist law that jacked up tariffs on over 20,000 different goods. The goal was exactly what we've been talking about, to protect American farms and factories. The result was a catastrophe. What happened next was a total collapse of the global economy. America's trading partners all around the world got furious and retaliated with their own massive tariffs. The result? World trade completely fell off a cliff. Between 1929 and 1934, it dropped by an incredible 2/3. It just made the Great Depression so much deeper and so much worse for everyone. And here's why that history lesson is so important right now. Back in 1930, trade only made up about 5% of the U.S. economy. Today, it's closer to 25%. Our modern world is just so deeply interconnected. What that means is the potential for damage from a big global trade war is way bigger now than it was almost 100 years ago. So that kind of leaves us with the big question, doesn't it? Are tariffs really a shield that can protect workers and industries at home? Or are they more like a clumsy economic weapon that, once you fire it, just ends up hurting everybody involved, the consumers, the businesses, and the entire global economy? The history and the data seem to suggest that even when the goal is protection, the reality is often just widespread pain.